Hello everyone, I am Arun MCom final from MPM Government First Grade College Karkara. Today I am going to deal with the topic double taxation treaties of MNCs. First we have to know the meaning of tax treaty. A tax treaty is a bilateral or two-party agreement made by two countries to resolve issues involving double taxation of passive and active income of each of their respective citizens. Income tax treaties generally determine the amount of tax that a country can apply to a taxpayer's income, capital, estate, or wealth. An income tax treaty is also called a double tax agreement. So, the goal of the tax treaty is to prevent double income taxation for companies or residents of each country, as well defining the circumstances of what establishes either residency or a business presence. A tax treaty will provide the parameters for reducing instances of double taxation as well as targeting methods of tax evasion. Some countries are seen as being tax havens. Generally, a tax haven is a country or a place with low or no corporate taxes that allow foreign investors to set up businesses there. Tax havens typically do not enter into tax treaties. So, some countries are seen as being tax havens. These countries typically do not enter into tax treaties. How a tax treaty works. When an individual or business invests in a foreign country, the issue of which country should tax the investor's earnings may arise. Both countries, the source country and the residence country, may enter into a tax treaty to agree on which country should tax the investment income to prevent the same income from getting taxed twice. So it is clear that both countries may enter into a tax treaty to agree on which country should tax the investment income to prevent the same income from getting taxed twice. The source country is the country that hosts the inward investment. The source country is also sometimes referred to as the capital importing country. The residence country is the investor's country of residence. The residence country is also sometimes referred to as the capital exporting country. To avoid double taxation, tax treaties may follow one of two models. First one, the Organization for Economic Cooperation and Development model, and the United Nations or UN model. The OECD tax convention on income and on capital is more favorable to capital exporting countries than capital importing countries. It requires the source country to give up some or all of its tax on certain categories of income earned by residents of the other treaty country. The two involved countries will benefit from such an agreement if the flow of trade and investment between the two countries is reasonably equal and the residence country taxes any income exempted by the source country. The second tax treaty model is formally referred to as the United Nations model, double taxation convention between developed and developing countries. The UN is an international organization that seeks to increase political and economic cooperation amongst its member countries. A treaty that follows the UN models gives favorable taxing rights to the foreign country of investment. Typically, this favorable taxing scheme benefits developing countries receiving inward investment. It gives the source country increased taxing rights over the business income of non-residents compared to the OECD model convention. The United Nations Model Conventions draws heavily from the OECD Model Convention. How is your company affected by a tax treaty? Once the tax treaty has been identified and reviewed, the next step is to look at exactly how it will affect business activity. The earliest way to understand how the tax treaty may affect a business is to look at a specific example of a US company doing business in China. The original tax treaty between the US and China reveals that there are several important provisions for the multinational looking to expand into China. It does cover income tax for foreign enterprise, defines permanent establishment, treatment of business profits, and the intention to eliminate double taxation. A few practical considerations for a US company doing business in China may be: first one, will a tax treaty affect how the business charges clients for invoices submitted in China? There is a withholding tax of 10 to 20% depending on the nature of the goods or services. So this must be taken into account for billing. The tax treaty may give some relief to a US company who can avoid double taxation on the same invoice by invoking the tax treaty status. So it is clear that for invoices submitting in China, there is a withholding tax of 10 to 20% depending on the nature of the goods or services. So this must be taken into account for billing. The tax treaty may give some relief to a US company who can avoid double taxation on the same invoice by invoking tax treaty status. Also, there can be some expense associated with the currency conversion that cannot be easily minimized. Next, how will methods of funds collect differ in the new market? As a result of currency controls, payments administration must go through several steps for involving invoice submitted in China. This will include invoice assessment, tax calculation, tax payment, currency conversion, and finally transfer of funds. So it is clear that funds collection is not dramatically affected by a tax treaty, but rather by domestic regulations. As a result of currency controls, payment administration must go through several steps for involving submitted in China. Next, will taxes be paid differently or at new rates? A primary element of tax treaties is the source rule, meaning that taxation occurs where title transfers on export or import of goods. This can be managed by various export and title clearing strategies. A primary element of tax treaties is the source rule, meaning that taxation occurs where title transfer on export or import of goods. Last one, how must revenues and taxes be reported to local authorities? There is a specific tax registration process required in China where a company can formally i- invoke treaty status. It is good idea to include the use of tax treaty status directly, avoiding any misapplication of tax rates. To conclude that, however, the treaties may not affect many of the procedural and administrative complexities that go along with international commerce. The tax treaty is a good starting point to identify what type of business income will be taxed, the rate that will be applied, and how to avoid permanent establishment in some cases. However, there will be a need for a more in-depth review of the local regulations that fall outside the provisions of the tax treaty to know exactly how to do business profitably in the new jurisdiction. Thank you.